So that brings me on to the next part of this hypothesis, which is that, as I said at the start, if we're going to have that bear market and recession, we will also slip into deflation for the third time in US's history. And that's simply because anything you do to the MT rate of change shows up in the CPI with a lag. Now, we had this big push following the C19 era in MT rate of change as they printed something like 6 or 7 trillion in the US alone. And then, of course, we had this snapback, which I've long been suggesting will eventually present as a short period of asset price deflation, perhaps in the middle of next year, there or thereabouts. I know there's a lot of narrative out there about inflation being sticky, and people, largely speaking, don't understand that we're measuring rate of change here instead of absolute, because that's what absolute inflation looks like. But we are not talking about absolute inflation here. We're talking about the rate of change, which should continue to be disinflationary here, should continue to trend down. And in the middle of next year, I still maintain we are going to see a short period of asset price deflation, probably catalyzed by the stock market breaking that blow off top trend line and smashing to the downside in extraordinary fashion.